Hey guys, this is Mark, construction worker turned zero DTE hedge fund manager. Today I wanted to answer some of your questions around trading and zero DTE and everything involved around it that I've gotten from you guys. Looking forward to it. Okay, so a question I recently got is, what is your edge and what is the edge in general of zero DTE?
The number one theoretical edge is that your stop loss executes and you can effectively trade a leveraged instrument and get out at a price that is reasonable. Like, I'm not assuming 10-cent slippage or something ridiculous, but let's say I put on a trade with a 3x stop loss. If I get a 6x stop loss, which could reasonably happen on a gap or something, that's not even going to remotely change my Sharp materially or cause some type of drawdown. So I think that's a pretty good assumption, considering I've done 200,000 contracts. A bunch of people are trading these. I use a algo and I've researched the national bid best offer and how orders are executed in detail. And everyone else is using a stop loss, except most people are using it overnight when the market is not liquid. The number one edge is options margining, which obviously everyone has, but as a fund, I can margin the 12-week risk-free rate of a treasury. So I have no interest rate risk, and then I can deploy basically 100% of that capital to trade. So we get a risk-free yield, plus we can trade with it. SPX, also with everything else, we get the 1256 tax advantage, so 60% long-term, 40% short-terms. Also, I'm dipping into rather large volume discounts now within my fund and interactive. So right now I'm paying roughly 35 cents for commission, and I get about a 6% rebate from the C-bill on exchange fees. That will continue to go down. I'd say around 10 to 15 million, I'd get that down to 25, and then around 25 million, I'd get that down to 10 cents, which if you've ever traded zero DTE, you know about 25% of your P&L is going to exchange and commissions, exchange fees and commission fees. So that volume drastically helps. Also, the daily compounding. So that is just a massive time velocity of money edge comparative to other instruments. Also, in regards to compounding, I think one of the largest edges with zero DTE options is that we're not really messing with Vega. So the options are pretty rationally priced. And in addition to that, even though I am a hedge fund and using financial instruments, we're a lot more similar to kind of a private equity firm or real estate fund, because if I sell $2 million of risk premium and we retain a $500,000 in P&L, there's no multiple assessed to that profit for my investors. Whereas when you're holding real estate and you're taking out debt, or you're holding the S&P or the Qs and interest rates go up or down, it can have nothing to do with the underlying businesses within that composite index or your positions. And all of a sudden you've lost money because the multiple expansion has gone down. So that is another huge uncorrelation risk. Also, the fact that these are very short dated, a bear market for 0-day pricing, assuming you don't have a slippage blow up, is about 90 days. So that also drastically can help your compounding, whereas you're never taking those large drawdowns for extended periods of time. So your capital is always at work for you. Also, with zero DTE, we can obviously define what our stop losses are with spreads, contract size, buying power. And by doing that, we can take a smaller risk each day, which limits our volatility drag to, let's say, a 5% drawdown. So we're only paying 25 basis points to get back to even. Whereas the compounding on a month-to-month basis is rather, but it's predominantly the ability to offset trades that are changing each day, basically, that we re-put on vol at a different price. And then the amount of correlation to a 9:32 trade versus a 3 p.m. trade is less correlation than, gold to SPX and such. Another thing I'll say too is my correlation to the SPX is 0.3. However, in all actuality, when people look at correlation, they say gold's only correlated 0.3 to the NASDAQ and the NASDAQ's only correlated to IWN. If we have a volatility expansion, all of that, its correlation is 1. Whereas if I'm trading something that I don't hold overnight and something happens overnight, or I have a stop loss intraday, I think that 0.3 correlation of me to the S&P is actually much more true and robust than the correlation of holding long equities, no matter how diversified they are.
Here's another question I got is, what is your zero DT portfolio strategy? And is it purely just implied volatility is less than realized volatility? And that's where you derive your edge and profit from?
So I'm trading, I like to call it locally concave, globally convex. So nothing will compare to the Sharpe of zero DT trades with stop loss. However, there's obviously potential risk with that assumption, and you'd never want to leverage your bankroll of like 80 to 90% because you could never come out of a drawdown that big. Whereas if you use 30%, even if stuff were to break, that's a reasonable drawdown to get out of. I've already incurred those gains, within 10 months of running a fund. So I think that type of risk to reward is somewhat responsible if something were to break up, because it's actually, a reasonable thing that you could come back from if the entire market went down or something. However, all market movements basically occur overnight, or all large market movements occur overnight, and that is somewhat priced in. So I'm kind of running like a calendarized structure where I'm putting on longer volatility trades of longer duration closer to the money, because the closer to the money we are, the longer in duration we are, the less that's going to decay compared to out of the money options closer in duration. So by basically holding some long straddles, some teenies, some convexity from 1 day, 3 day, 7 day, 14 day that are aging into it, I can offset the cost of those by basically selling a bunch of zero DT trades. And when the market doesn't move, we still profit. But if the market rips 1% overnight or trends for a couple of days in a row, those pay off massively. Granted, those have no drag on my portfolio. Everything I run is at least break even in terms of expected value. And again, addition to those, huge benefit of economies of scale. If I'm selling a 7 DTE straddle, I can use that long leg on Interactive to not buy a wing to basically cap my buying power. So I'm creating, I could reuse it, let's say 3 times a day if I'm getting stopped out or something. So like I'm creating $15 value a day on every contract on both sides. And there's multiple hedges that I'm running like that too. So it's also creating more of a cost efficiency on it. And then if something were to rip, you could protect yourself with that. But essentially what that lets us do is we play arithmetic mean versus geometric mean. So by preventing when any convex moves happen, we don't take any large drawdowns because we're carrying that long vega, that long gamma, comparative to when the market doesn't move, we're still able to create a return off of our credit trades.
Hey guys, always appreciate all the questions. It helps me learn when I look into things. If you have any more, please drop them in the comments, comment, subscribe. And if you have any other questions, please drop them down so I can look into them and answer them on next week's episode of Q&A. Thank you.